Hello, everyone. In the interest of keeping the agenda flowing, good morning. My name is Joe Keenan. I'm with BNY Mellon, and I'm pleased to moderate today's panel of experts. I think you're going to find the next session particularly valuable. On behalf of BNY Mellon, and I will note that we're going to end right on time because we're sponsoring the mixer afterward, and we want to get every nickel out of this that we can. So, given that, though, the truth is we do have some flexibility. We're starting a little bit late, and out of deference to the panelists, certainly at the end of our session, we want to make sure, as we saw the last panel, that there's ample time for questions, because the goal here really is to provide as much information as we possibly can. And I'll give you the briefest of commercials for BNY Mellon Asset Servicing. I have the good fortune, along with a number of my team that's here, to be responsible for our ETF services business. And we're really passionate about exchange-traded funds at BNY Mellon because it's really been a very successful business for us. But we're equally as passionate about education, because if we can help continue the adoption of these products, but the adoption in a way where end users, whether they're fee-based planners or even retail investors, absolutely understand that these are tools, and with a tool you want to use it the right way, it will help, I think, continue what already has been proven to be a high-integrity business. It'll continue that terrific momentum. Just as a side note, for us, within BNY Mellon Asset Servicing, the services business focused on exchange-traded funds and exchange-traded products is our fastest-growing business, and that happened through what for us certainly has been the toughest few years in the market. So we're hopeful that that terrific performance continues. And again, thank you to IMN, and certainly thank you to all of you for being here and being awake and ready to learn more, hopefully, about ETFs. So on to the panel. Real quick, again, we're gonna be a little flexible in that, again, the title is focused on research and evaluation. Not all products are created equal, and yet the sub-bullets have a particular focus on indexing and benchmarking. And we certainly will talk about passive product and the underlying indices, but we want to hopefully share for the group today and lever off of, again, the terrific panel of experts that we have assembled to not only talk about the evolution of indexing, how the underlying indices are being used for the creation of new product, but then also talk about the importance of research. And a number of us who have been involved in the industry for many years used to bemoan the fact that there really wasn't any real good research out there, that in some ways ETFs were kind of like a box of Crayola crayons, and you needed folks to help you paint a picture, either for your client or even for your own portfolio. I think that has changed. I'm sure you'll agree. We're hopefully going to share with you a number of different resources that have emerged. So, again, I think it's going to be a terrific panel. And with that, I'd like to ask that each of the panelists to introduce themselves and also kind of the respective focus of their firms. So maybe we'll start with Mark.
Sure. Hi, my name is Mark Abssy. I'm the Senior Index and ETF Manager at the International Securities Exchange. We're based in New York. We are primarily an options exchange, but there is a part of our business which is involved in index development, creation, and since about 2007, we have found that licensing indexes to ETF issuers and other issuers is a lot easier than filing 19B4 filings with the SEC to list options on indexes. So we've taken the path of least resistance, and we are one of those boats that has been rising with the ETF tide. Currently, we have about 30 indexes. In total, there's 16 products in the marketplace that are tied to our indexes, with about 850 million or so tied to them. So not the largest player, but well, I'd like to think we're a little more innovative than some of the larger kind of benchmark index shops out there.
Good morning. My name is Debbie Fuhr, and I just started a new company with two colleagues. It's called ETFGI, and what we're doing is research on the ETF industry as well as consulting for the industry and for investors. My background is I started covering exchange-traded funds back in 1997 when there were 21 of them and $8 billion. So really have followed the evolution of the industry on a global basis, and thought that talking and educating would have been done years ago. And I think, if anything, the importance, as Joe alluded to, is more important now than before. And we'll be selling our services on a subscription basis.
My name is Greg Friedman. I'm the COO and head of product for Russell Investments. We're a relatively new ETF player. We've been in business for about a year now, but Russell has a long heritage of indexing as well as consultative and manager-to-manager research. So it's a natural evolution for Russell to get into the ETF business, since many of the Russell benchmarks have been used by large ETF sponsors for the last 12 years. We're happy to be here and able to talk about the next generation of ETFs, which we believe are going to be more around smart beta and active, in addition to the already existence of asset-defining benchmarks.
Hi, good morning. I'm Todd Rosenbluth. I'm from S&P Capital IQ. So just a clarification, not the rating side of S&P and not the indices side of S&P, but the research side of it. And so we at S&P Capital IQ have research and rankings on over 700 equity ETFs on a platform that we're actually demoing outside. You can take a look at during the break. Our approach is that, as one of the prior panelists referenced, is that ETFs are truly a portfolio. We do analysis on a fundamental basis, looking at what's inside. So the quality of the stocks, the quality of the bonds. We're leveraging our S&P Capital IQ equity research team. We're leveraging the Standard & Poor's ratings team to do analysis. So when we put an overweight or a top ranking on an ETF, it's because the underlying holdings stand out to us from a valuation and from a risk standpoint, and we take into account the cost factors. So, prior panelists have talked about you want to know that you want to be in a certain market, or you want to know you want to have a tactical approach in a sector, and that's where we can hopefully help to come into play by being able to tell you what makes one ETF in that sector different than the other one with our research. And so happy to do the Q&A and then to be able to talk to people and show our platform later on today.
Great. Thank you, Todd, and the rest of the panelists. Well, again, for this panel, the next half hour or so, we're going to touch on the first 10 minutes or so, just indexing in general and how it's evolved. Lots of experience here, and there's been an extraordinary amount of evolution. In fact, and I hope Wikipedia is right, I had to look this up. But indexing has come a long way since the inception of the Dow Industrials Index way back on May 26, 1896, if you can believe that, so 115 years, give or take. And while there are a number of so-called institutional benchmarks that are certainly prevalent and hold lots of assets and exchange-traded funds and other products, the NASDAQ Composite, the S&P 500, the Russell 2000, MSCI EAFE, just to name a few, there has been a great deal of innovation in the business, in particular over the last 15 years. Clearly, I believe, and I think the panelists would agree, directly correlated with the growth and emergence of the exchange-traded fund business. Some would argue the ETF industry has been this key catalyst in the evolution, especially with the emergence of alternative weighting methodologies, quantitative model-based, and now so-called investable indices. And we're going to hear a lot about, Greg noted, concept of intelligent indexing or smart beta. So what I'd like to do is, and again, this is going to be very free format because I want spontaneity from the panel. So I'd like to ask, and I'll look to see who gives me that bright look like I have a good answer, a few questions around indexing. So first, if the panelists could share their views on what developments they believe have been critical in terms of indexing evolution, and then also in that, to the extent that you have some views, what's important when you look at a particular index or benchmark to consider, in particular if you're looking at it to determine whether or not you should purchase an ETF. So what do you think, Mark? I'll start with you.
Sure, why not? All right. So with regards to the development of an index and what, say, 20 years ago, what would be called an index, and currently, I think I touched on this earlier when we were talking, Joe. Believe it or not, I think that the slowness of the SEC probably has done more to help advance the idea of what an index is and what it could be. And the reason why, people will say, well, geez, no, it's the marketplace, because the marketplace wanted this. The marketplace wanted thinner slices. The marketplace wants strategy. The marketplace wants all these things. Yes, they do, but by modifying, transmorgifying, for all you Calvin and Hobbes fans out there, the what is being held out as an index is the path of least resistance for the marketplace to get what it wants, right? So instead of filing for an X type product with the SEC, well, no, we will wrap that in an index. We will call it an index. We will create a methodology for it. It'll be as quantitative as possible, so the index calculation agents can calc it. We'll be able to tell everybody what's in the index every day, and we will move ahead. right? So, and it sounds maybe a little disjointed, but I think at the root of it, this is, again, the market working out how to get what it wants. And they do that by saying, oh, well, I can put this, I don't need to make an active strategy. I can make an index of this. And it's an index, so therefore it fits in the current scheme of things. I can get this product listed and launched. And it's also, quote, what the market wants. So,
maybe to extend that a little bit,
yeah.
and I know, Greg, you've, for your many years, both with not only with your current firm, but even way back with some of those early products that Debbie noted, you've been involved in licensing indices, really taking a look at them. Again, could you share for the group not only kind of what maybe in the early days you looked at, but now and today, probably a little bit of a segue into what you're doing at Russell, what you think is important and how the whole range of benchmarks should be looked at.
Absolutely. I did not give you a bright look, by the way. That was just...
That was a twitch. It wasn't a wink.
It was a
huh?
twitch,
Okay.
yes. The index business has changed dramatically. Prior to 2000, the indexers got a small flat fee for indexing. It was a data service. The broad-based indexes were there because they'd always been there. And I see the index generation as well as the ETF generation really going side by side. Starting in 2000, the firm I came from, iShares, really changed the way the indexing became part of ETFs. We really connected with the index provider. We gave them the juice. We had them put skin in the game. And all of a sudden, the index providers saw that the ETF industry was a way for them to really reinvent themselves. There was the broad-based indexes, and that was it. They sold data. They were a data firm. As ETFs grew, the index business grew because ETFs were transparent. Indexes were a great way to show that transparency. People wanted different methodologies. It wasn't just market cap. It was equal cap. What do you do if you want just Japanese exposure or Hong Kong? How do you slice and dice? And the ETF providers were right there lock, step, and barrel. So it became a very nice partnership between the index provider and the ETF provider to create these new sleeves. It was transparent. It was cost effective. It was tax efficient. All the things that we've come to know and love about ETFs, the indexes provided. So it was a natural course. Index providers made more money. There was option based upon the different indexes. People could do research, what was in the index. So then as we built out ETFs going further in the last few years, it's what's in the index. Is it made by a reputable firm? Is it liquid? So all the concerns that people had been experiencing with mutual funds over the decades are now becoming really clear and transparent in both the vehicle you buy, the ETF, as well as the index that you're benchmarked against.
Thank you, Greg. I think, Todd, you want to add to that?
Yeah, I would take this slice and dice where Greg was going and then just highlight a few things that has happened at Russell, has happened at other firms that offer indices, as well as that we've seen more theme-based offerings. So you can have a low volatility or a high beta approach to the strategy, depending upon where you see the market going. You can have more of a dividend theme, and you can take a look whether or not a company has a high dividend versus a record of consistency in paying a dividend, depending upon how you want to do that. But to come to your second lead-in kind of question as to because these are offered by different ETF providers and because they're backed by different indices, what's inside them is not as simple to be able to do. So to choose the cheapest low volatility portfolio or to choose the cheapest dividend portfolio really is missing part of what it is, because they may have 30% exposure to utilities or 30% exposure to financials or no exposure to consumer discretionary stocks, which is an area that you want to be able to have exposure to in a more cyclical slant of the economy. So being able to dig deeper inside, I think, is something, as the industry has evolved, there's a need to be able to do that more and more. And I think Debbie would agree on that.
And I think if you don't mind, I'll maybe extend the questioning just a little bit and ask you to respond, Debbie, because I know you've had lots of experience. I've heard it said, well, you know what, does the benchmark really matter? If I'm looking for total market exposure, do I care about the Wilshire versus the Russell 2? Or are there other things that I should be worried about, in particular the ETF space? And what we're trying to do here a little bit is build on the sense that there's now almost a confusing array of indices and now products, and in some ways you really need a divining rod to figure out what to look at. So I'm curious if you could add a little bit to that, Deb.
Sure. I think part of it comes down to the user and how they're using ETFs, because clearly, if you think back to the early days, the users were traditionally institutional managers who were saying, I want to equitize cash. So the key thing for them was then, what is my benchmark and how well does the ETF track my benchmark? So in the early days, the early webs were very attractive because many people are benchmarked to MSCI and would say, I want exposure to MSCI Japan. And so they would buy the ETF because it tracked quite well. Over the years, what you've seen is some of the factors that have driven the evolution, I believe, is the fact that active funds are not delivering alpha. And so if you look, many people, and look at last year as an example, S&P did an analysis where 81.2% of active managers whose benchmark is the S&P 500 did not beat the benchmark. That's pretty appalling, right? So then you say, okay, so people are embracing using index products. The array of index mutual funds is pretty small. The array of futures is pretty small. And so what you found was people embrace the ETF wrapper as a way to deliver tools to investors. And that's what's actually driven the advent of smart beta and other things, is people realize hard to find an index product, hard to find an active manager, so I'll go down the ETF route. Not everything, though, works in what I would call a fund. So exchange-traded funds are funds, and the evolution, as Joe alluded to, is we've actually seen that for a while everyone was just calling everything an ETF. Now they call everything an ETP, and I'm not sure that helps people understand there are significant differences. So if you're buying something that's structured as a note, you're taking 100% counterparty exposure to that issuer. I'm not saying that's good or bad, but what you do find is if we had another Lehman event, you probably wouldn't find yourself feeling very happy if you wait until still many people are waiting to figure out are they going to get money back from their notes or swaps that they had with Lehman. So understanding the structure from a counterparty, from a regulatory, and also from a tax perspective, because many people have embraced using these products, ETPs, for exposure to physical commodities, which is a good thing because it allowed people to get exposure to the same gold that central banks own. But many didn't realize that, and I don't give tax advice, but you're probably taxed as if you own a collectible. So it's not that anything is good or bad, but it does require that you do your homework. And that's the challenge, because if you look at the industry on a global basis, at the end of April, we published a new little update. And what you find is there's 4,601 ETPs with 9,246 listings from 195 providers on 54 exchanges. So to be able to go through that array of products and the nuances, because even if something's an ETF, it's very important that you understand, are you buying a 40 Act fund or a UCITS fund? Because you really shouldn't buy UCITS, which is a European fund structure. So understanding all these nuances is really very important before you make that investment decision. So it's really, think of the benchmark as your menu. Then what you need to do is think about it as like going down and buying eggs. What is the structure? Do you want an omelet? Do you want hard-boiled eggs or what? And then is it an ETN, ETV, ETP? And then what's inside of it? Is it fully replicated? Is it optimized? Is it buying shares, futures? Is it physical? And then the cost, because I think you need to look at the total cost, not just the total expense ratio, because as we move to using futures, the transaction costs aren't included. If you're paying commission, if there's spread, all of those things are very important for investors to understand before you make that investment.
First of all, thank you, Debbie. That's very helpful. And we're going to kind of dig a little bit more deeply because there are other considerations even beyond the structural considerations that Debbie highlighted that we want to make sure that the group is aware of. But before we jump away, one last question on the indexing space. And it could be even today or recent innovation, but I'm curious, each of the panelists, if there's anything that's on the horizon that really intrigues you, that you think is finally something that's going to be very usable broadly for the industry, or in particular around exchange-traded products? Maybe, well, let's say we'll do it in reverse order. How do we do that? We'll go to Todd this time, see what you have to say, Todd, in terms of new developments or anything you've seen in your firm's research.
Yeah, I mean, I would say that what we've seen more is that we saw the slicing and dicing on the equity side going back a couple of years more closely, and I talked about that with the low vol and the beta and the dividend theme of it. But we're seeing it more and more, I think, on the fixed income side. So being able to take corporate bond ETFs and being able to slice that into investment grade and non-investment grade, and specifically certain sectors within the specific area that a provider launched earlier this year. We've seen a large number of fixed income ETFs come onto the marketplace in 2012, and many more that are registered to do so. I think we're going to see more and more of that to give people the options to understand the credit risk or the duration and be able to structure the portfolio the same way that I think they may want to do on an individual bond basis, or the way they may be doing with with separately managed accounts and individual mutual funds. You're going to see more slicing and dicing of that on the fixed income side, and I think that's really exciting for every investor, because you want to have exposure. You may not just want to have exposure to the Barclays Ag. You may want to have slice and dice to that, and being able to have research that supports that is something that we're looking to bring to the table later on in 2012.
Thanks, Todd. How about you, Mark? What do you think?
Well,
I mean, when we prepped,
yeah.
you talked a lot about even understanding the benchmarks today and doing the research, kind of understand what's inside and some of the tests. But
yeah. I mean, certainly, and a lot of what my colleagues here are doing is advising to look into and perform analysis on the constituents of an index, on the holdings of a fund, to make sure that it's that they're what you want. And B, really what you want. But even beyond looking at the results of the methodology, it's also very important to look at the methodology itself. I mean, people at these types of events, there's usually somebody who will say, and I'm usually the one saying it, at some point, although it's painful, get a prospectus for at least the holding you have, that's your largest holding. Read through the entire thing. It will be painful, it will cure your insomnia, but in the long run, you're better off for it. Now, the easier, much less painful way to do that is to get the methodology guide for the index and read that. Okay? Another great thing is that if you do have a question on that index methodology guide, contact the provider. There are plenty of times where I will get calls from folks who are invested in FCG or SKYY or any of the other products that I've developed indexes for, and they will say, "Hey, why'd you put this in there, or what's the rationale behind X or Y?" And I will go and I'll sit and talk with them and say, "Okay, well this is the methodology. There's a top level quantitative approach, and to get to the comment earlier about investability, and I think it's kind of interesting because the larger, more traditional benchmark index shops are now starting to label and tweak their existing indexes to make them, quote, investable, which to me is kind of funny because that's kind of what they always have been for me. Because when we do make an index, right, the index business that we have is not a benchmark index business. We are kind of a custom index shop, and we are developing, purpose-built indexes to provide exposure to a certain sector, but also to provide that investable exposure. So we will do things like, instead of talking about market cap versus equal weight and these big discussions that always occur, we're doing some pretty radical things, like with the ISC Cloud Computing Index. We recognize that it's very difficult to say specifically what is a cloud computing company. And you have companies like Apple and IBM and HP and people that are kind of all over the place, yet still important. So what we did was say, I'm going to create a bucket, which is a tech conglomerate bucket. I'm going to give that a 10% allocation. And regardless if there are 3 names or 15 names, that bucket's only going to be 10%. Then I put on my best swag-inducing hat and said, these names I'm going to call pure play cloud, and these names are going to be non-pure play. And I said between those two buckets, the aggregate market cap of each bucket is going to determine what the allocation between pure play and non-pure play is. And within that, because it's an index and I'm not necessarily picking favorites, we're just going to equal weight. And my goal is that over time, as there are less companies that are pure play, they will get a lower weighting. But as that sector grows out and matures, companies become truly pure play cloud computing companies, that index is going to naturally morph to have more weight to the pure play side. Okay? So again, it's not so much what is in the index, what is in the fund, but what's the rationale? How do people get to that? And is the index built such that they're going to have revisions every time the industry changes? Or is it truly an intelligent index which is going to say, okay, as the industry changes, this index will change with it? Right?
And that's probably a good segue into Greg, because I think that what we've seen is sometimes indices have been static and haven't really responded. Just a few short years ago, everybody was running around saying, oh, is asset allocation dead? Because no matter what tools you used or how you allocated your portfolio, you lost money. So clearly there's a desire to, at a minimum, minimize risk within portfolios, and folks are much less tolerant of volatility than they were previously. So I wonder if you could talk a little bit about that and innovation. Great.
Absolutely. Yeah, I think there's two really exciting innovations around indexing. Yeah, as we all talked about before, there's the asset-defining benchmarks. Nowadays, you're seeing a lot more around investable indexes, and that's where the excitement can begin. It's, we talked about before, it's the slicing and dicing. It's the exposure to different asset classes that before you didn't have access to. And I think the next generation is going to be, how do you make that even smarter? So what we've done at Russell is create a bunch of indexes that are either they're factor-based, so you have low volatility, low beta, high volatility momentum, as well as some investment disciplines. So what that is, it's an index, so it's transparent. There's a methodology. You're not dependent upon a stock picker or the quality of that portfolio manager, but it's a methodology you could drill into that research firms that are on either side of you can look at. They can validate the liquidity, the structure, how safe, how liquid, but it gives you different types of exposure. So where before you had the choice of, do I want Japan? It's a binary decision, yes or no. Do I want gold in my portfolio? Yes or no. Now you've got a U.S. equity portfolio, and you've got portfolios or ETFs, our shop as well as other quality sponsors out there, that let you say, I like U.S. equity, but I don't like the volatility. How can I either dial that down by adding some of the low volatility, or just change out? Instead of having a Russell 1000 portfolio, have a Russell 1000 low volatility portfolio as piece of your portfolio. And I think you'll see a lot more of that. And that's what we're coining smart beta or intelligent beta or dummy down alpha, which the marketing guys don't like the word dumbing down. But it's how do you get
paid less for dumb alpha?
Yeah, you do. Yeah, you do. I won't continue. But it gives you different types of strategies. So these indexes are now becoming investable indexes. So when people ask me, is this a benchmark? No. A benchmark is the S&P 500. It's the Russell 2. It's EFA. It's the Barclays Ag, which is still very difficult for me to say Barclays Ag versus Lehman Ag. But these are now indexes that give you the transparency, a methodology, rules-based, that allow you to be a lot more precise in how you invest with volatility, beta, different countries' exposures, fixed income, commodities, things that have never been available to us. So I think as we go forward, you'll see a very different naming convention between benchmarks and investable indexes, and I think the ETF industry will develop more into investable indexes that give unique exposures and tools that advisors and investors never had before.
First of all, thank you. I'd like to extend, we touched on this a little bit, but in the few minutes that we have, and again recognizing that we want to have some Q&A, maybe for you, Debbie, to try to say, if we could, to take it from, it's not just about the benchmark or the index. You've touched on the fact that there are structural considerations. There are clearly other considerations now that a number of research firms, including your own, have started to tease out, like underlying liquidity. One question I'm dying to ask, and maybe we can talk about that at the end, is do any of you ascribe to this view now that somehow the prevalence of ETFs is driving market correlation and then therefore making it tougher for the stock pickers, although when it was easy they didn't do a very good job either, but tougher for the stock pickers to beat their underlying benchmark. But I do think that it's essential to let the folks know some of the other critical considerations beyond tax and some of those that you touched on.
Yeah, so liquidity is a good question because, the U.S. has really driven the ETF industry around the world. And one of the oddities that we have in Europe is when trades are done in ETFs, you're not required to report them on exchange. So in Europe, 70% of the trades are OTC and 30% are typically reported. So MiFID II, which is a set of regulations, we will finally see that ETF trade reporting is required. So one thing to remember is with ETFs, they have this unique feature that you have secondary trading, which is the trading in the ETF, but you also have the ability through brokers, if you have a large order, and large I would say is typically more than 20% of the average daily volume, you can go to a broker who can do a creation. You don't need to do this work because the brokers are very knowledgeable. The people who trade ETFs tend to be sitting on the program trading desk. So you just can say to them, here's what I'd like to do. They will advise you whether what you want to do is realistic or should you split up the order, etc. So liquidity is something that's important to understand, but clearly there's a whole array of people who can support you in this. And so the true liquidity is how liquid is the underlying. I think the other thing that you see is how people are thinking about ETFs has really evolved a lot. If you look at the most significant growth here in the U.S., as well as in many other places, is people using ETFs to create entire strategies. So target date, global asset allocation, using tools that my colleagues on the panel have talked about. So we really are seeing ETFs going from, I'm just going to use it as a tool to equitize cash, to really building blocks and solutions. And I think that's where we're seeing ETFs getting into the 401k market. We're seeing ETFs here in the U.S. Retail is huge. It's probably half the business. And if you look at some of the significant growth areas, some interesting data comes out of Charles Schwab, where last year the ETF industry in the U.S. grew by 5%. The assets custodied at Charles Schwab grew by 9%. So at the end of the year last year, $122 billion of the ETF industry was at Charles Schwab from all different providers. So if we talk about correlations, actually what you find, and the same is true of volatility, when correlations go up, when volatility goes up, people embrace using ETFs because it doesn't make a lot of sense to spend a lot of time picking individual stocks or bonds or trying to. You're better off using an ETF product that gives you the sector or the country or the region or whatever you want exposure to. And you have to put in perspective. Although ETFs get a lot of press, they're talked about a lot. Someone started earlier saying they're 10% of the mutual fund industry. So the size of ETFs relative to benchmarks is tiny. So they can't affect everything if they're not the largest thing out there. So I don't believe that ETFs are causing correlations to go up, causing volatility to go up, but I do find that when those things happen, more and more people embrace ETFs.
I would just add a little color to Debbie's last comment. When you look at all the assets tied to a benchmark like SPX, it's around, I think, $5 trillion. That's mutual funds, separate accounts, all kinds of things. So there's about, we'll call it $5 trillion there. When you look at the Russell 1000, ostensibly that was built as an SPX beater, right? So that is very highly correlated to SPX. And when you look at the Russell family of size and style indexes, there is about another, say, 4 trillion plus. And the thing about the Russell family of indexes, if you've done the research, the lowest correlation between any of those group of, say, 10 indexes is about maybe 0.65, 0.66. So they themselves are highly correlated. So you've got about $9 trillion of highly correlated assets that are chasing after the same pool of equities versus $1.2 trillion of extremely diversified assets that are in everything from physical commodities to futures to option overlay plans to Malaysian stocks to wheat to I don't see how those two, how the one overpowers the other. So this idea of ETFs causing correlation, all these 3 o'clock effects and all these other types of things, I just don't see it.
Todd, I know you wanted to make a point.
Yeah, I would just, on the first part of where Debbie was going in terms of just, understanding liquidity and understanding what's out there, I think that's part of the due diligence that people should be doing before putting a client into an ETF, is understanding what is the bid-ask spread of the ETF and how does that compare with other alternatives that are out there. What is the standard deviation of the ETF and how does that compare with other alternatives? So looking not just at the underlying holdings but also at the ETF level and understanding some of the characteristics, because once you're in it for your clients, you're in it, and then you've got to find a way to get out when you do your reallocation or your satellite strategy shift. So understanding those factors and making that be part of the holistic analysis and due diligence, I think, is extremely important before doing so. So I mean, I would agree. I would suggest reading a prospectus, but even just looking at some of the summary level statistics and comparing and contrasting a couple of different ETFs that you think fit that criteria and figuring out which one best suits your client's needs instead of just choosing, again, the cheapest one out there, because the cheapest one out there may not be the cheapest one out there in the next week given the ETF pricing wars we've been seeing in the last couple of months.
And all of us and many of the speakers you'll see here today are, we're embroiled in this industry, so this stuff we hear all the time. But I'm always concerned, in particular when you have an audience like this. Just a few weeks ago, it was headline news that there was a VIX product that kind of de-linked completely from the market. And even internally in my own organization, I got a barrage of emails from senior management saying, first, do we service this product? Second, what is it? And there really isn't a deep yet understanding. Back to Debbie's point around structural considerations. This was an ETN. Again, counterparty risk. Again, not very different than an open-end 40 Act fund, where if there's reduced demand, the shares can be redeemed back. So it's really, really important. First, not to get caught up, because for better or worse, there's a lot of limelight shining on ETFs and exchange-traded products broadly. And with that, we've certainly seen a high level of confusion, and there are absolutely, Todd, to your point, and I think the point of the panel, there are costs that are beyond the total expense ratio of the underlying product. So you need to, sometimes the cheapest product is not the best one to choose, and sometimes what seems like the best one to choose may not give you the diversification that you're looking for. We're almost out of time, but I'm sure that given the last session that there's some questions in the audience, and also, and this is what the moderator gets to do, all these folks are here all day, so you can grab Debbie, you can go over and see Greg and Todd and Mark and ask them some real specific questions, not only about their respective firms, but in particular around some of the emerging research. It's a little tough to give broad-based plugs to some of the different research portals that are out there, but I'm sure on a one-on-one basis you can get some good tips. Some of it's subscription, the best stuff. Debbie made me say that. But then there's also a lot of information that's available free, or at least initially. But you're going to want to be able to sift through that. So, with that, there's a question right here. Yes, sir.
Do you want to make an attempt to become more convincing? Do you want to make an attempt to be more convincing and marshal forward some arguments of why do you think that ETFs did not affect and do not affect the increased correlation? You just said, well, I don't think so.
I have
it's
research.
Good enough, but
I have some research I can send you. It's I could take up probably 20 minutes describing it, which I don't think everyone would appreciate because they'd like a coffee. So I think if we could exchange cards, that's probably. I do have empirical research to share with you if you'd like.
Anybody else?
Yeah. The ETFs have always been the catalyst for the media. Something's always going to go wrong. We're the new kids in the block. We're fast growing. We've taken a lot of assets. Some other parts of the industry might not feel so pleased. There's complex structures that aren't easy to explain. So I've been involved with ETFs since '96, managed the first webs. And I've heard every story that they're not going to survive difficult times. Well, they survived the Malaysian currency crash. They survived 9/11. They've survived the market crash. They have been accused of, my favorite was, you can inside trade using ETFs. You can break the market. I mean, it's been out there and it's going to happen. That's what you get for being a fast-moving industry. And the whole industry's done research. ICI has done research. There's been nothing out there that has pointed to ETFs being flawed or being a cause of any of this. And it's going to continue until ETFs become a little more mainstream. The one plug I will make is there's just an understanding. People need to understand there's been a lot of bad press about leverage and inverse. They are good products run by quality firms. You just have to understand how to use them and when to use them. ETNs, good products. These are the note products. Fantastic firms sponsor them. You have to know what your risks are. Each of these new indexes, they're investable indexes. You need to know what you're buying. So it's not an industry or product issue. It's really understanding and being aware that we are going to be the target, like it or not, and we'll just keep plugging through with the answers, the data, the facts, the research to help our clients.
Some of the same arrows were slung at program trading a few short years ago, and now ETFs seem to have stepped in and taken that as well.
Could I have a follow-up, please?
You know what? I would say, if you don't mind, there's a gentleman behind you that wants to ask a question as well. Yeah, okay. All right. The senator from Minnesota has...
manager who is using ETFs exclusively.
Yeah.
Okay.
So, in particular, Mr. Friedman's answer was, well, they were accused of all kinds of things and etc. That wasn't the question. I don't mind the ETFs being the cause of increased correlations. It doesn't affect my strategy. I just would like to know the truth. Yeah. Now, I have a different opinion, obviously, but, you know, from how I posed the question. But the overall discussion, ETFs will survive, blah, 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 this is not the question. Do they cause increased correlation?
Well, again, my
the
question to the
facts
panel was,
say
do
no.
we believe, this group doesn't believe, you clearly do. What I would offer for consideration is the growth of commodities-based, and in particular precious metals-based ETFs, has been driven by a clear presence of an absence of correlation. So 10% or more of the trillion in assets are focused on commodities. So there's clearly a tool that exists within this structure to help reduce correlation within your portfolio. I don't think, personally, for what it's worth, that the answer's out there yet. There's clearly, you know, two opinions. I do think that, back to some of the work that Debbie's done and others have done, that some good empirical research is going to be critical to understand how these products are impacting the market. But to just simply say the emergence of these products or why active stock pickers can't be successful in achieving alpha seems like, to me, a little bit of an easy tack to take. That's, for what it's worth, my view. But go ahead. And one more question? I'm cutting into our coffee. Come on, somebody's got to have a good one. Somebody's got to say, I agree with the correlation. In the back, there's a person in the back.
Of course she agrees with you.
Pardon?
Of course they agree with you.
I gave my panel softball questions. Come on here.
My question's not on this. I'm going to take you back to the focus of your panel, which has been on looking underneath at sort of the engine that drives the car, if you will. And can you comment on what you think about the recent trend or announcements that the ETF providers are going to become index, or are going to create their own indices instead of getting their indices from index providers?
Yeah, that's a great question. I'll open it up to the group. I'm sure they all have an opinion on it.
Yeah, I don't know. There has been a big push for index providers to become sponsors. As the industry grows, firms have recognized that there's good revenue, good reasons to be in both pieces of the business. At Russell, we have the indexes and the ETF divisions are completely separate. So the SEC and the regulators are very concerned about firewall procedures. So at Russell, for example, we have a whole index division that I'm not allowed to speak to. I'm treated like a client. And since I came from iShares, I can tell you I'm treated worse internally than I was externally. So, but there is a concern. I've been interviewed by a lot of people and talked to the SEC about this since we have a filing, as well as other firms, of how to get the firm to operate together. I think the concerns around fixed income. I think the SEC is concerned that a particular firm might have a position or make markets in a particular bond issue, and that might influence the index construction or the index methodology or what's in or what's out on a particular day. I will say all firms are very ethical in this space. There's 4 or 5 applications with the SEC for joint or affiliated index calculation agencies. There will be firewall procedures. There will be an extreme look at making sure that the index business is pure. They're not influenced by the sponsors. And if and when the SEC gets comfortable, we'll see that. But I don't think it's going to happen within the next few months, is my guess.
Thanks, Rick. Todd, you want to make a point?
Yeah, well, I would also add the plug or the